I think it's very likely that U.S. dollar denominated savers will experience a deterioration in the purchasing power of their U.S. dollar denominated savings of between 8 and 9% a year on the low side.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for June 27th, 2023 through July 4th, 2023 while supplies last. This week we feature Asahi Silver Rounds at $3.49 over spot, 2023 1-ounce silver maple coins at $4.25 over spot, and backdated 1-ounce silver Australian kangaroos at just $3.89 over spot. First, the Asahi refinery continues the legacy of famed private mint Johnson Matthey, which they purchased in 2015 and refined with the same attention to detail, cementing their status as an LBMA certified supplier. Their 1-ounce rounds are 3/9 fine and on sale for just $3.49 over spot. Next, silver maples were the first silver sovereign coins to be minted at 4/9 fine purity, and the 2023 silver maples remain one of the most in-demand coins today. They come 25 to a tube, 500 to a box, and are available at $4.25 over spot. Next, backdated kangaroos are 4/9 fine 1-ounce silver sovereign coins of Australia. They are renowned for their purity and design. They come 25 to a tube and with just 250 coins to a monster box. They are the most affordable monster box available, especially at just $3.99 over spot per ounce while supplies last. Our specials this week are IRA eligible. And if you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this widely followed returning guest, Rick Rule, the former CEO of Sprott Asset Management, now the CEO of Rule Investment Media, joins us this Wednesday, June 28th, 2023. Rick, thanks for coming back on Liberty and Finance.
Dunnigan, it's always a pleasure. Thank you for having me back.
Our viewers always tell me that they're grateful for your presence here, so we want to keep having you back. And we'll want to talk near the end of this talk about the upcoming Rule Symposium on Natural Resource Investing that's coming up in about 4 weeks here, and that there's some special pricing that's about to go away here in the next few days. And there's a less expensive way of going, a very affordable way to do it virtually if that fits people's life situation better. So we want to make sure people stay tuned for that, and there'll be details about that in the description of the video. But first, if we could start talking about what's going on right now in the banking system, not only in the U.S., but globally. There had been a flurry of concern a couple months ago when there were about 4 or 5 significant bank failures, both in the U.S. and in Europe. And for the moment, it seemed like the sky was falling and people were running around trying to get their money out of the banks and get it into other places such as perhaps precious metals or land or whatever, but just not in the banks. And now that there's been several weeks without a bank failure, it seems to me, as a bullion dealer, getting fewer calls from people saying, I just want to get my money out of the banks. There's still some of those, but much fewer than there were a few weeks ago, a few months ago, that it's astonishing to me how quickly maybe the new normal of bank failures suddenly seems like, well, if that's not happening on a daily or weekly basis, that must mean everything's fine. You're our credit analyst, and you look closely at the solvency and stability of financial institutions all the time. That's what you do a lot. And so could you give us your view on whether anything is actually, the danger is past and blown over? It's sunny skies from here on as far as the banking system and people's deposits as savers being safe in the banks.
I'm glad you asked that question because I've been amazed at the recency bias exhibited by people, particularly in the United States. And I need to be clear. There are a lot of institutions in the U.S. banking industry that are very solvent and very well run. But there's a few that aren't. And the ease with which the response to the crisis has passed with regards to depositors and investors astonishes me. Make no mistake, the banking industry is not out of the weeds, and the idea that the government fixed the crisis is absurd. The government caused, not fixed, the crisis. And the same set of circumstances that caused the crisis is in place today. I'm not saying that we're going to experience another rash of bank failures, and I'm not saying either that people need to rush to get their money out of the bank. What I'm saying is that the investor response to the banking crisis was at best neurotic. Consider this: $400 billion switched from community bank deposits, many of which were solvent, to money center bank deposits that paid no interest. People looked at banks that were, quote, too big to fail, and they took money out of accounts that were paying them 4.15, 4.2%, and put them into deposits that were paying them nothing. This points, unfortunately, to the innumeracy of the American investing public, and I think that people need to look at that. And the fact that no bank has failed in the last 4 to 6 weeks, at least none that I know of, doesn't excuse the fact that, in particular, the long-term real estate holdings, mortgage holdings in bank portfolios are increasingly troubled. If you look, as an example, at the challenges in Class A office real estate, a sector that everybody thought was absolutely bulletproof, and you look at fairly good landlords, let's say BlackRock, as an example, defaulting on first mortgages in New York City, in San Francisco, in Chicago. Somebody's holding all that paper. And the people who are holding that paper are not gonna get whole. In addition, the people holding that paper are bankers, not landlords. They will not be able to operate those buildings as well as the defaulting owners will. I'm not saying that this is a hyper crisis. I'm saying that because no bank has gone broke in 4 weeks and no newspaper headline has screamed about the banking crisis, that people think the crisis is past. Not 6 weeks ago, websites that compared the duration of deposits relative to the duration of loans and the time mismatch between overnight funded deposits and assets with 6 years or greater duration, we're getting hundreds of thousands of hits. Now, those same websites are getting no hits, although the facts have not changed. There were and are a lot of banks in the United States that, were they forced to match their assets and liabilities, would have a substantial enough discount in the net present value of their assets that they would be insolvent. That hasn't changed. I'm not trying to say that the Fed is going to force the issue, that the market's going to take over. I'm saying that the lack of concern exhibited by depositors in a 6-week time frame is absolutely, completely staggering to me. I guess that's what I have to say. And I'm staggered, too, by the response where depositors ignore institutions that pay them interest in favor of institutions that don't pay them interest. The circumstance just seems stranger and stranger to me around banking.
Well, I'm sure you've thought that through, but to the ordinary person who has never read a balance sheet in their life, doesn't understand half of the terminology and acronyms that would go with that, et cetera, when they got the feeling in their gut and through osmosis from a lot of the press that was coming out about these bank failures, when they got the feeling that there were unsafe places, that they might lose it all, that they might get locked out away and not be able to touch their savings, the thought of worrying about the loss of a couple fractional percent of interest or something on an annual basis seemed like mild compared to the risk that they thought was present there. So maybe you want to put both of those in perspective. You were saying that maybe there are some small and regional banks that may be well run. Are those necessarily immune from the contagion that could happen in a bank run type situation?
Well, first of all, there's some big banks that are well run too, and the big banks have a plethora of deposit products. My own big bank, and I won't name them because I still do business with them for a little while at least, at last count had 14 different deposit products, only 5 of which promised to pay me no interest. When I picked and chose among their deposit products, something that they would prefer I didn't do, of course, I found that I had a choice between getting paid nothing or getting paid 4.05%. Clearly to me, 4.05% was better than nothing. The other alternative available to everybody, although morally I'm opposed to it, is Treasury Direct, where savers and depositors can buy short-term U.S. Treasuries, which pay in excess of 4%. 4%, make no mistake, is arithmetically way, way, way better than nothing. The fact that almost $500 billion of U.S. depositors' money has decided to go for products that pay nothing is astonishing to me. And while people can excuse themselves from the responsibility for their own future by their own ignorance, if that's a choice that they make, they deserve the fate that they get. Perhaps what you and I should do someday is do a depositor's financial literacy interview. I think if people listening to this think it's a good idea, in the comments section at Liberty and Finance, they should say, financial literacy discussion, because I'd be happy to contribute to this. I'm not suggesting, by the way, that I know everything that there is to know about banking. What I do know is that getting paid beats not getting paid. And there are fairly simple ways for people with an IQ, north of 10 to determine with just a little bit of work whether their institution is solvent or whether it isn't. As I say, I'm not meaning to scold all depositors. I'm just saying I am astonished at the rapid nature of the lack of concern around structural imbalances in the banking industry that continue till today. The change in sentiment over 6 weeks, when the underlying facts are virtually unchanged, I would have thought at age 70 that not much could surprise me. And I'm really, truly surprised, Donegan.
Part of what may also be sort of placating people's fears that were flared up for a moment there is, again, a narrative being laid out by the Fed saying, we're going to engineer a soft landing, don't worry. I mean, these are the same people that were telling us, don't worry, inflation is going to be transient, or inflation is going to be moderate, or inflation is going to be temporary, or whatever. Now they're telling us we're working on a soft landing here. This isn't going to, and the banking systemic banking problem is never going to happen again. That was an older one. But so talk to us about the realism around a soft landing and what, in your view.
Well, first of all, you and I, people who have no faith in the Fed whatsoever, no faith in government whatsoever, need to consider the possibility that the Fed will engineer a soft landing. We need to challenge our precepts just as those on the other side need to challenge theirs. I myself continue to be impressed with the amazing resilience of the U.S. economy. I'm not trying to say that there aren't people experiencing hard times, but the continued jobs growth, just the general strength of the economy and the market, in the face of these interest rate rises, has surprised me. I think another thing that the Fed has done is that they have reduced the expectation of inflation. People are less concerned about inflation because people pay attention to the Fed's headline number. There is a chance, I think, that managing the economy with higher interest rates can slow the economy down enough so that in conjunction with, as an example, 5% current yields on treasuries, we get back to a real yield. If the perception among the populace is that the real rate of inflation is 3.5% and they're getting 5% on their savings, the Fed will, from their own point of view, have already engineered a soft landing. And there's a chance that they will accomplish that. My own suspicion is that the Fed, maybe not Congress, but the Fed, has a real fear of inflation themselves. And given the strength of the U.S. economy, I believe the Fed is likely to and likely can get away with at least 2 more 25 basis point rate increases through the balance of the year. We will see then, Denigan, whether or not the strength of the U.S. economy is less transitory than I had been afraid of. My fear is that the impact of higher interest rates will be delayed, but it'll be useful to see that. You will notice that I've used the phrase perception a lot. And I want to talk about the way inflation is calculated for the public discourse. Remember that the CPI, Consumer Price Index, while it's marketed as a cost of living index, is not. It's a politically oriented matrix of factors that I think is increasingly meaningless. In the first instance, it's, quote, hedonistically adjusted. Now, if that hedonism had some balance, had some bonus for me, if they gave me bourbon or something to enjoy hedonistically, that would probably be okay. But that's not what it is. What it says is that, as an example, rental accommodation is, according to the Fed, of higher quality than it used to be. And so they hedonistically adjust for increases in rent by the qualitative improvement of the housing stock, irrespective of people's individual hedonism and their enjoyment of their apartments. The truth is that rents are going up faster than they're being calculated due to hedonistic adjustments. The other concern I have is that when it suits the Fed, they only talk about core inflation. Core inflation is inflation net of food and fuel. I just came back from Quebec City, so obviously I consume food. And as your viewers can tell by looking at me, I like to eat. So inflation net of food and fuel doesn't reflect on my cost of living. But the single strangest aspect of the calculation of inflation, if you utilize the CPI, which is what you're asked to do, is that it doesn't include the cost of government. It doesn't include tax. I guess if I didn't have to pay the tax, I'd bitch less about the index. But I do. Tax is, for the average household, the largest single expense they have, bigger than shelter, bigger than fuel, bigger than energy, bigger than transportation combined. And it's not in the index. So if the inflation index is meant to inform me about my own cost of living, then the calculation is fraudulent. Or if it's not fraudulent, because fraud goes to intent, at least it's fallacious. And the idea that not just Americans, people around the world are increasingly content with the fact that the forces of inflation are more benign than they were when they aren't, I think is problematic. I'm not saying that, like so many people who profess beliefs similar to my own, that the world is going to hell in a handbasket, that the U.S. dollar is going to blow up, that, I'm not saying any of those things are going to happen. What I am saying is I think it's very likely that U.S. dollar denominated savers will experience a deterioration in the purchasing power of their U.S. dollar denominated savings of between 8 and 9% a year on the low side. And I think that when people are making calculations about what they need to earn on their investments, what they need to earn on their savings, what they need to save, what they can spend, that they are understating this sort of pernicious erosion of their purchasing power. And they're less concerned about it than they ought to be. In fact, much less concerned about it than they ought to be. I've before on your show, Dunnigan, talked about the arithmetic around the U.S. 10-year Treasury, which is the benchmark of savings and investment products around the world. Right now, the government purports to pay you, I think, 3.4%. And they will, because they can print if they have to. So think about the arithmetic of getting paid 3.4% on your savings and having the purchasing power of those savings decline by 8% a year compounded. That is a 4.5% annual loss, guaranteed, cumulative and compounding for 10 years. What that means is that the U.S. government solemnly swears that if you give them $1,000 now, they will give you back less than $600 in purchasing power over 10 years. As I've said before on your show, this is one promise I'm almost certain my government is prepared to keep. But it's not a promise that makes me sanguine about the purchasing power of my savings in U.S. dollar denominated instruments. And when people look for hope in fiat instruments abroad, which is to say savings denominated in other currencies, I think the outlook is worse. I think the U.S. dollar will outperform other fiat currencies, not because of the strength of the U.S. political system or the strength of the U.S. economy, but simply because the other currencies are even weaker than we are. Our mutual friend Doug Casey described the U.S. dollar as an IOU nothing. He describes the euro as, quote, a who owes you nothing. There's a lot of furor now about a new fiat currency, the so-called BRIC. The BRIC, if you look at the financial performers of the constituents of that currency, would be best described as a nobody owes you nothing. Now they're prepared to offer membership to Argentina. 7 sovereign defaults. And these guys are going to back a new fiat currency. This is laughable. And people need to take this into account when they're planning their financial future. Sorry about the rant, but this has really been on my mind.
But this is a key point. You're talking about a lot of perception around the emerging or potential or about to be announced BRIC currency is that it would be backed not by the governments necessarily, but by commodities, perhaps including precious metals, oil, who knows what else. What do you know about that, or do you think that that's unknowable yet at this point?
It isn't unknowable, it's fraud. Imagine that you have the financial equivalent of $100,000 in a BRIC currency. And imagine that those governments behave the way that they do, which is to say that they inflate away the value. And then let's say that you decide that they need to pay you in what they've denominated in the currency for. Let's say that the Kaiser family from Florida decides that they're going to turn in their BRIC and the Saudis are going to give them some oil, or the Chinese are going to give them some gold. Dunnigan, remember, these guys have guns. They have hundreds, or in some cases, thousands of years of history of defrauding people with currency. It's just that the provider of the fraud, the purveyor of the fraud, isn't one government, it's many governments. This is one of the silliest prognostications I've ever seen. The reason that the U.S. dollar is the predominant medium of exchange in the world is that although people around the world don't trust us much, they trust us more than each other. Imagine the Chinese shipping a whole bunch of cool stuff to Zambia and getting paid in kwacha, a non-convertible currency that the Chinese can't spend. As little as the Chinese trust us, they won't say this, but they trust us more than they trust the Russians. They trust us more than they trust the Saudis. So while I believe that the dollar has problems, I don't think that the dollar is challenged by Brazil, Russia, India, China, Saudi Arabia, or Argentina. I think the challenges confronting the U.S. dollar emanate from Moscow. Not from Moscow, I'm sorry, emanate from Washington. We have weaponized the dollar. We've weaponized the SWIFT banking system. We have made U.S. dollar denominated savings certificates of guaranteed confiscation through inflation. The dollar's only enemy is the U.S. government. And even the U.S. government isn't capable of destroying the dollar as fast as other governments are capable of destroying their currency.
One more phenomenon, and it may be related to something we've already talked about, which is this normalcy bias, or recency bias, I should say, of people thinking, gee, if we've gotten through a few weeks without multiple bank failures in our country, that means the storm must have passed, is that we've seen a sharp downtick in the retail bullion market. There's simply a markedly reduced furor of people to get money out of the banks and into non-bank intrinsically valuable asset class of gold and silver in the last few weeks than there was in the previous few months. Your view of that, since you watch all of these moving pieces on the chessboard, what you think the phenomenon is that we're observing there, and whether you think it's justified based on fundamentals, et cetera?
Well, I think from the market's point of view, it's silly. Obviously, from a bullion dealer's point of view, it's tragic. And from my point of view, as a systematic bullion buyer, it's wonderful. I will continue to buy bullion, both gold and silver, gold more than silver at my age. And I'm delighted that I will be able to pay less in my systematic buying campaign because other people feel gold is less necessary than I do. So I think it depends on your point of view. For all of the reasons that you and I have discussed many times, Dunnigan, I believe that gold in particular are an essential part of someone's wealth preservation and someone's savings. And I believe that silver can play a role there too. And I think that silver is a wonderful instrument for a speculator. In addition to that, the idea that the need to add gold and silver to a portfolio is substantially less than it was 6 weeks ago absolutely blows my mind. I mean, I must say, it delights me. I still have great liquidity. I still have a great income. I'm still enjoying very good capital gains, and I am still deploying into gold and silver. And I am delighted that I'm able to do so for less money. As you know, my new employment activity, Battle Bank, proposes to be a lender against gold and silver. And I'm frankly delighted that some of my customers will be able to buy it for less money. In other words, more collateral for me, less outgo for them. All of that delights me. What scares me is the myopic view of the global investor. I suspect that that's due to two things, but I'm no psychologist. Let me give them to you just for fun. The first is that I think that investors' perceptions and behaviors, we've talked about this before, were generated over 40 very benign years between 1982 and 2002, the 40 most benign economic years in human history. Lower nominal and lower real interest rates, globalization, inclusion in the workforce, freer trade, all those kinds of things were all wonderful. And I think all that changed in 2022. But I don't think that the lessons that people learned in the preceding 40 years changed. I think that people are confronting a changed circumstance with the original perception. And I think that's a mistake. I think, too, that people would prefer not to be scared. I think that people prefer that they consign their financial future to somebody else, something insolvent like the Social Security Trust Fund. And I think that people are tired of being worried. I think it's more fun to believe, or psychologically easier to believe, that the big thinkers of the world, the Bidens, the Trudeaus, the Merkels, the Feds, have your back. And I think that they point to 40 benign years of economic climate as evidence that the big thinkers have the world under control. Long-term capital management happened. We survived. 2008 happened. We survived. COVID happened. We survived. Russia versus the Ukraine happened, and we survived. And we survived because of our strong leadership and our strong institutions. That's wrong. Or if it isn't wrong, it's certainly a contingency worth considering. And it's certainly a circumstance that hasn't changed as dramatically in the last 6 or 7 weeks as perception has. And while that's all amusing to me and frankly profitable for me, I think it's tragic for humankind as a whole.
Well, you know that I share that last view, especially with you, because having founded my channel back in 2013 under the name Reluctant Preppers, with focus on preparedness, meaning ordinary people positioning themselves in such a way that they're more likely to be able to weather any upset that may come their way and to be able to survive and thrive financially and in all other ways as a family. It troubles me deeply that in the face of persistent risk that people suddenly think that it's all is well, happy days are here again. And my wife and I are among those who also are weary of worrying. I can certainly empathize with that. But when you're on the tracks and the train is coming, not time to be just, whistling a happy tune. You've got to take meaningful action to reduce your risk and to position yourself better. Now, you've got an upcoming seminar, the Rule Symposium on Natural Resource Investing in Boca Raton, Florida. It's a beautiful facility. I've been there last year. I'll be there again with you this year. But for some people, that provides a challenge, either because they don't have the time off to travel or the funds to afford that. I understand that we should talk about a virtual option that's available, and also that there's only a few days left before the end of June here, that if they want to get in before prices go up, speaking of action, that'd be a time to take that action.
Well, there's a whole bunch of things around that I want to talk about. The most important thing that you can invest in is yourself, your own education. The discussion that we just had is a discussion that we feature at the conference. Jim Rickards, who had a front row seat in many of the former financial train wrecks, will be talking about that at this conference. Nomi Prinz will be there. There will be a lot of people with big picture paradigms that you don't hear on CBC or CNBC or places like that. And I think that's important. As you described, for the first time in our history, rather than having to come to Boca Raton, which isn't a hardship for me, but if you want to watch it from the comfort of your own home, we have a live stream, a virtual option. People who attend either virtually or in person will have access to the conference recordings for a full 6 months. I know myself that I can't absorb all of 50 hours of programming in 4 days. And although I put on the conference last year and I put on the virtual boot camps that you've been around, I've played each of them an average of 3 or 4 times after the event to learn the lessons more fully. And that's all there. Why attend the conference at all? Well, first of all, the gurus, the big picture, understanding the issues that you and I have discussed today from people whose job it is to understand them and not to understand them from the mainstream point of view. If you come to a worldview that is concerned about the things that I'm concerned about and Dunnigan that you're concerned about, we have a range of analysts that will tell you how to implement strategies to prepare yourself from that. These are not people who came to natural resources after they failed in crypto and after they failed in marijuana and after they struck out as supermarket analysts. These are people who've been involved in natural resource and precious metals markets for decades through good markets and bad. Much more importantly than that, frankly, we have real players. We call them the living legends. People who have built multi-billion-dollar companies in natural resources and precious metals from scratch. The lessons that they've learned doing that are worth more than every textbook in the world combined. You can hear them describe how they built the business and how building the business made them better investors and how you can become a better investor too by utilizing their lessons. Beyond that, at our conference, either live or virtual, our exhibitors are curated. At most conferences, the qualification to be an exhibitor is a check that cashes. In our conference, as a public company exhibitor, as an issuer, you have to be owned in accounts managed by the conference sponsor. If you are a non-issuer, if you're a bullion dealer, or if you're a coin dealer, you have to have no customer complaints in the Sprott or Rule network, which means, as an example, if you were a coin dealer and we had gotten a complaint about you in the last 30 years among the 250,000 people in the Sprott universe, you would be automatically disqualified. So in addition to everything else, the exhibitors, which attendees tell us as content too, are curated. And finally, Dunnigan, I'm certain enough of the value proposition that at our symposium, either live or virtual, or any of our boot camps for that matter, we have an ironclad money-back guarantee. If you attend virtually or attend in person, and you don't believe that I didn't give you good value for money, I will absolutely, positively give you your money back. I would prefer, but I don't insist, that you tell me how I failed so I can make my product better this year. But that obligation is not on you. If for any reason, and by the way, I've refunded money from people who said I gave them too much content, that the conference was too good, that they couldn't absorb all of the information. I gave those people refunds. If for any reason you don't feel that I delivered, I'll give you your money back.
And if people want to find out more about how to do that, folks, you only have, 3 days here till the end of June. That's when the early bird prices are gone and the full prices start. So make sure you look in the description of this video. There's a link there for how to register for the conference. When you get there, you can choose either the in-person or the virtual conference.
You have 3 days left. And by the way, if you register for the virtual conference, the Livestream conference, and later find that you can come to Boca Raton, we will credit you. In other words, you can make the upgrade, not a problem. And, we probably should talk about the facility. The Boca Resort, if you can attend live, is pretty amazing. 245 acres in Boca Raton, half a mile of Atlantic Ocean waterfront. Michael Dell has $1.4 billion into this facility. A room in the tower, which costs normal people $1,300 a night, costs my attendees $300 a night. It would have been amusing to have those negotiations live on Liberty and Finance. But despite that, we're giving them to you. So I really encourage people who are looking to invest for their future and their children's future, people who don't want to trust Biden or Trump or the Fed or Merkel or Trudeau with their future, people who would like to take control of their own future and avail themselves to different points of view. I would really encourage those people to attend the conference either live or virtually. And I'm, as I say, confident enough that we will assist people that it comes with a 100% ironclad money-back guarantee.
In addition to the upcoming conference, Rick, in the past, you've offered some additional ability for people to reach out for your, I won't call it advice, but perspective, information. Are you wanting to re-up that offer at this time?
Absolutely. Any Liberty and Finance listener that cares about what I think about natural resources can make it personal. Go to ruleinvestmentmedia.com, list your natural resource portfolio, and I'll rank it personally 1 to 10. I'll also comment on issues where I think my comments might have value. Once again, please no crypto, please no pot stocks, please no tech stocks, please no general market securities, just natural resources and precious metals, Rule Investment Media. By the way, at Rule Investment Media, if for some reason you're concerned about banking or dissatisfied with your own bank and you want to learn about my bank, Battle Bank, a sanity-based bank, in the question and comment section, write bank.
Excellent. Rick, as always, we're grateful for your visits here on Liberty and Finance. We hope to see if we can squeak one more in next month before the symposium. I hope we can. And very grateful for you also offering these ability for our viewers to reach out to you and get your input on their particular situation and give them some guidance that's going to help them to maybe pick the best eggs out of their basket and maybe let some other ones go. So grateful for that. And thank you for joining us as always here on Liberty and Finance.
Pleasure, and I look forward to welcoming you to our investment symposium in Boca Raton, Florida. I'll be delighted to see and host you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.